Welcome back in YouTube. So Target just reported earnings. We're going to go into those earnings, give you a fair market valuation with our valuation system, but we need to address the elephant in the room. There's very few people in the world that can wear a leather jacket indoors and pull it off with class. David Copperfield comes to mind, Chris Angel, although he doesn't normally wear a shirt underneath, and then Jensen Huang. What do all three have in common? They like to either make things disappear or reappear, and with Nvidia's earnings, there's an implied move of around 7 to 8%, which is hundreds of billions of dollars of market cap that could go in either or direction. That's either going to make people a lot of money or make a lot of money disappear. So it's going to be a very, very interesting earnings release, and it's going to be interesting to see how the market digests it. As we know, this has been a very different type of market that we're in, where basically 7 to 10 names have carried the majority move of this market, and Nvidia is at the top of that list. We are about 20 minutes away from the market opening. Target is down roughly 10% and looks like it could be on its way to finding the recent lows once again. So operating income margins are improving, going to 5.3%, which reflects a 140 basis point move of improvement, and first quarter comparable sales are down nearly 4%, which is actually in line with expectations. They're noticing that sales are declining primarily in discretionary categories, and they're offsetting this with the beauty category. Now, even though sales are declining, the thing I do like to see, we're going to take pros and cons from this, is the fact that operating income is actually improving. Cost of sales are down, total current liabilities are up, but long-term debt and borrowings are down, so good to see that. Balance sheet overall still seems pretty healthy. We're seeing sales coming down. We're seeing revenue decline, but we're also seeing some efficiencies within the company pick up. So I actually think this is kind of a net wash overall when we look at it, total efficiency of the business. So with Target, revenues are down, but efficiencies are actually picking up. That's something good to see. And then when we think about them shifting the business more to the beauty side because discretionary is kind of falling off here, that's also good to see. So they're kind of shifting their business model here. And this sell-off could actually lend a better buying opportunity for somebody who wants to be a long-term investor in this company. Balance sheet overall still looks pretty healthy. Let's start looking for forward guidance and plugging in our numbers. So for the second quarter, the company expects 0 to 2% increase in its comparable sales and GAAP and adjusted EPS of $1.95 to $2.35. We look at the full year GAAP here. Currently, the stock is trading right around $140. They're guiding for a GAAP EPS of around $8.60. Gives it a forward PE sitting right around 16.5 times. And on an adjusted basis, we're looking at 14 to 15 times forward earnings on an adjusted basis. So overall, I think valuation's pretty reasonable here when we compare them to their peers. Let's just pull that up and take a look. We're gonna have a dividend rate pushing 3% with this sell-off. So I want you to keep that in the back of your mind. And when we look at dividends, is this a company that grows dividends? That's going to be my biggest concern. Dividend payout ratio sitting right around 50%, which seems pretty healthy. This is a company that has grown its dividend for 55 years and paid out a dividend. So when we think about entering this price, this could be a compounder if we enter at the right price point. And so our goal right now is to kind of talk through this business. It looks like revenues are going to remain flat, and I projected this out, so let's get into where valuations should be. When we compare them to their peers, after this sell-off, it looks like they're going to be trading below a market multiple or a sector median multiple. So I'm going to be really, really cautious here. I'm using 0% growth rates, 2% growth rates, and 2% growth rates. Now, I do think they can surpass this, but I'm just erring on caution and saying if this company kind of just flounders around and stays flat, and I'm looking for an 11% rate of return. If we factor in nearly a 3% dividend, we could be looking at a better than 11% rate of return on this. Where do I need to be buying the stock? So we get two price targets here. We get a price target of 101.54. Now on a free cash flow basis, we're looking at basically 109 to 110. I'm gonna keep this very simple. I'm gonna say that a good buy target is gonna be anything between 100 to 110. Currently, the stock is sitting at 141. I do think this is a stock that I would possibly reach around 118 to 120. And then really be looking to add in if it somehow got into the low 100s or even high 90s. When we use these fundamental analysis, it's never going to be a perfect science, but it kind of guides you to where maybe a fair entry point would be when we're projecting out what the company's capable of doing. Now, of course, I used 0%, 2%, and 2%. So any sort of top line growth or any sort of more efficiencies we can pick up within this business is actually going to grow is actually going to compound that rate of return, because we're going to see earnings follow. And as we always say on this channel, when we get earnings growth, you get stock appreciation. So wherever earnings go, stock price usually follows. And so with this one, I was very conservative in my update. I definitely can understand reaching in the 120s on this one. And that's even with stating the fact that this company is probably going to stay flat for this year into next year, and probably won't see any sort of growth until 2026 and beyond. With that being said, it looks like they're doing some things that are going to make the business more efficient. So this sell-off could actually be a good buying opportunity. As always, appreciate your time. We will see you in the next one.